Hello and welcome to the July 2024 edition of the monthly market update by Kingdom Focus Financial. Today we're joined with myself, Derek Malden, Michael Smith, Chris Pagato, and Chuck Atzweiler. We're going to give you about 10 minutes of information about what's going on in the markets that we see. Here's our obligatory disclosure statement, and take it away, guys.
All right. Hey, thanks, Derek. And welcome, everyone. Glad that you're here, taking the time to listen in as usual. We're targeting keeping this in that 10 to 12 minute range. Again, this month, try to keep it that short lunchtime, bite size meal for your economic viewing pleasure this month. Sorry, I hope you can appreciate my humor. But here on the screen is our theme for this year. And I wanted to remind you of that. We've been talking through the acronym of FOUR. If you've missed previous monthly updates, we've already talked about the federal interest rates and rate cuts and oil and the first two topics. We intend to work through U and R, but next month, because this month I want to focus in and take a little break from our acronym to talk about the upcoming election and what I think the second half of 2024 might mean for all of us as we anticipate a pretty important election in front of us and what we expect it to do within the economy. Obviously, we can't predict, right? I don't have a magic wand or a crystal ball, but history is our guide, as it usually is, Chuck, right? And
Absolutely.
let's just dive in and talk a little bit to give people an idea of what to anticipate, hoping that we can help you feel good about and make our way through some choppy waters that we see coming ahead. And that way you'll expect it. When it jumps out at you, you're not going to scream in fright, but you'll say, yep, Michael told me about that. And we'll make it through to the other side. So Chuck, why don't you dive in and share with us what history has to tell us about what we can anticipate?
Thank you, Michael. Great to be with you and everyone. And I love the way you reference history. There's the old saying, those who don't study history are doomed to repeat it. So it is part of our research and we take it very seriously. So here you can see before you the data that was garnered by Dow Jones and Company. They went all the way back to 1928, a long time ago, right? A little less than a century. And what we find is there's a seasonality effect to market performance. What the chart doesn't show is that people gain knowledge by going back in history. There used to be something called the January effect, which worked itself into February. Why? People reposition in the beginning of the year regarding their portfolios due to taxes. We'll look at the performance in November and December. Now that's the time frame to jump on the bandwagon. So the reason we're showing this is sometimes this doesn't always work out. Now, please look at April and May. Folks may know that this year, 2024, was a really rough April, but May was really good. So you can have switches in the performance of given months based on track record because people try and gain. So all this being said, Michael, what we see here is probably several of the indexes, the NASDAQ, the S&P sitting at all-time highs. We're looking at maybe a summer swoon. If there is one consistency, Michael, it's September. We call it September morn. So we're anticipating a little bit of a rough patch here based on a couple of things, not only just historical seasonality patterns, but where the markets sit today with the NASDAQ and the S&P right at all-time highs.
Yeah, perfect. And Chuck, I'll just remind everyone, if you paid attention in some of the previous monthly updates that we did, we overlaid how a presidential election year looks a little different than the norm. This includes all years, presidential election and non-election years. And in a presidential election years, this graph slides a little quicker, right? So hence why April here was more like a May, right? And
yes,
I think we might see that pattern continue, and that August and September might be our mournful potential months this year, maybe lingering into October, just so that everyone is aware. But we expect, being at all-time highs, that somewhere between now and that election, this market's going to take a big breath, is what we're anticipating,
Precisely.
and probably give some of that back. But we do anticipate that we'll see that again after the election. And it's not party related. It really has to do with cycles that we see take place. We're sitting in a really good spot, though, this year, Chuck, from the first half of the year so far.
Absolutely. And I think that's come to the surprise of many, not to us, but I think to most investors it has been.
So let's talk about how that monthly performance looks at in terms of numbers, right? Because we see those big bar charts and we go, oh my goodness, look how rocky it is. But when we break it into percentage, it really doesn't look as scary, does it?
It really doesn't. And I know Chris is going to get into a little bit of this on specifics. But so what we try to do is bifurcate the market, right? The overall stock market into 4 different indices. You got the Dow Jones, which is much more blue chip value, US stocks, the S&P 500, a little more momentum growth, certainly the NASDAQ, mostly momentum and growth, but the Russell 2000, the smallest publicly traded companies in the index. And look at where the red lies, right? It's in August, September, and October in those small cap businesses. You can see even in August and September for the large momentum plays, we see a slowdown or a pullback. So just allow your eyesight to move to the red here. And again, we're just trying to throw caution at the wind and then simply saying, like we said in the last slide, all-time highs, the seasonality effects, fading some of those smaller companies, maybe some of those more value-oriented as we move into probably a little bit of a rough patch, albeit with an election, a major election forthcoming as well.
Right. Yeah, and this in no way is meant to be a doom and gloom. We think things are going to continue to grow, but just a pause, right? We're not
Exactly.
foreshadowing any type of collapse or calamity or anything of that sort. And again, remember, you guys that have been working with me long enough, you know, we separate emotions of elections from markets and elections, right? And here we're talking about markets. And it may look bad on a bar chart, but on an average, September's down just over 1%, right? And I say an
Exactly.
average because sometimes it's positive, other times it might be -3 or 4 or 5, but somewhere in that process, it all balances out. And we're talking swings of between 1 and 2% typically. And in the long-term scheme of things, which is how we manage those portfolios, we will ride through this. We'll stay in the boat. We don't get out. We don't dive into the water, right? Where the sharks are. We stay in the boat. We ride through the rough patches and we'll make it out okay on the other side.
Well said, Michael. Look at November and December across the board on all those indices. I just had to throw that in, right? You suffer a little in the Russell 2000 through the summer and early fall, but look at how it ends up on average. Great point.
Absolutely. So let's talk about presidential election year specifically, Chuck.
Yeah, certainly. So a really neat chart here. So going back to 1950, so nearly 75 years of data, certainly presidential election years are kind, if you will, even in this sell in May, go away cycle. They produce a median percentage change of positive 3.3. But what I'd like people to do is just look above that. You'll see the pre-election number, right? Yes, it's positive 2.0, but the positive percentage of actual observations is 63%. So, you have a little above a 50% chance of getting a positive return. But Michael, what I love is, money in the bank's almost on that post-election, right? You see the median change of 4.7. So, and a lot of people unfortunately say, I'm not going to get involved in investing until I know who the president, who their cabinet met, and they wait too long. And I think what I really can take from this chart is here that if we're very prudent, we kind of wait through the summer here, get a little bit conservative, and then we look to see that year-end rally. That most likely is what occurs again in a presidential election here.
Absolutely. And if I can use an analogy that I think everyone will understand, here we are in July, right? This is beach weather for people that like to go to the beach, and think about how waves work, right? And a tsunami in particular, it's building up offshore. And so it pulls that water from the beach and exposes the sand a little bit more, only to come crashing in a big wave later, right? And I think that's what we're sort of anticipating with the market. We're going to get that drawback, that little bit of a pullback. And then after that decision of the election comes into play, we do expect, and history tells us in most election years, we see that wave come then crashing back in and filling that void back up that it had taken from before. So keep that in mind as we work our way through the next 5 to 6 months here. Thanks, Chuck. I appreciate that. Hopefully this pause helps people understand that. I want to take just a minute, if I can, and talk about how that may impact our portfolios. Not in specifics. If you're watching this and you are working with us and you have questions, call our office, and we're happy to go through your specific portfolio. But in general, what we intend to do here is we're going to trim some of those equity positions in the third quarter. We're going to pull back from some of those small and mid cap and international positions and utilize more of the fixed income and the interest bearing instruments that we have, earning that somewhere between 4 and 8% right now on an average out there. That can always change, but for now we anticipate those numbers will stick for the balance of this year. And we're going to just kind of do this little bit of a trade-off as we're anticipating equities to pull back. We're going to capture those and stick those into some more fixed income for a period of time. And then as we approach that election, we'll shift back so that we can hopefully ride that wave of growth with those dollars as we move into 2025 later this year. Chris, do you have anything you would want to add in particular that might benefit clients as we talk about how that'll impact our portfolios?
Yeah, sure. Really, it's a case of the macroeconomic conditions and surrounding the election. And right now, obviously, we've all been dealing with some of the inflation and the Federal Reserve keeping rates where they are. Well, large cap companies where people have been moving their investment dollars to, in some cases, have stronger balance sheets. They don't need to borrow money. As Michael was saying, the small and mid cap companies, they rely a little bit more on that interest rate financing and borrowing money. So they're impacted significantly more by a high interest rate environment. As we're getting towards the election and we're getting through that cycle, the Federal Reserve is looking to cut interest rates. Maybe we're going to get 1, 2, 3 this year. It remains to be seen. But they're certainly looking as we get into 2025 and moving that direction. And that's only going to benefit those small and mid-cap companies. So while the anticipated struggle in that space is likely, historically speaking, through the August, September, October period, as we get closer to the election and the likelihood of rate cuts, those companies will be more likely to rebound in those scenarios. So by coming out of some of those, lowering our percentages, not exiting them, but lowering our percentages pre-election gives us the opportunity to use the pieces that are getting some momentum, take advantage of those higher rates in the money markets and the fixed income pieces, and then reposition later in the year as we get to the fourth quarter and into 2025 to take advantage of those likely Fed rate cuts that will benefit the smaller and mid-cap companies, and then put those dollars back to work at that point.
Perfect. Thank you. And hopefully that's helpful to all of you who took the time to listen in. I want to add one slight tidbit in there as well. It's not just about the investments, but from a planning perspective. And Derek, I'll look to you here a little bit. During times where we anticipate a pullback, I mean, there's a couple of things we focus in on for clients. In particular, Roth IRA conversions, right? Normally people might wait till the end of the year. Well, if we're going to get that pullback here in late summer, early September, what a great time to take advantage of a Roth conversion. Would you agree?
Absolutely. The best time to do a Roth conversion is when the market takes a dip, because you can move more shares for the same dollar amount. So from a tax perspective, we grow more shares in that Roth tax-free down the road versus doing less shares. But in addition to that, some tax loss harvesting. We've had a lot of growth this year, and so an opportunity to take some of those positions that might dip a little bit and move those around when we have some downtime as well.
Excellent. So if you're listening to this and you don't want to just hide in a closet and wait to see what happens with the election, but you just want to take it in stride and know that we're going to come out okay, give us a call. We're happy to walk you through any of the specific planning things that may benefit you during this time frame. We stay busy around here. Market ups and downs gives us opportunities, and we want to make sure we take advantage of them with you. So thanks for watching. As always, we appreciate you working with us and the trust and confidence that you have in us. And we hope that you're able to enjoy your summer, spend some time with family, and we will see you again next month. Thanks.